Hi, Debbie. It's great to see you. Really excited about talking about what's going on in Washington, D.C. and what we're learning about the big, beautiful bill. So maybe you can start with some background on where the bill stands and where we estimating or anticipating it going.
Well, the House bill actually passed this morning. I think they were up till 1 in the morning last night, and it actually passed. So the next stop will be the Senate, where it will undergo a similar markup process. I know they're hoping to get that done in June. And once the Senate has their bill, then they'll have to pass their own version of the budget reconciliation package. And then the House and the Senate are going to have to reconcile their differences. And then they will separately vote on and pass the reconciled version. Now, and then they'll send it to the president for signature. I know that originally they thought the time frame for this might be July, August, but the president has indicated that he'd really like to be able to sign this bill on July 4th. So the pressure's on. He even went to Capitol Hill to lobby for the bill, which is a little bit unusual. Usually Capitol Hill goes to the president. President doesn't go to Capitol Hill. So this is, I think he considers this to be one of the most important things he promised and that he needs to deliver on.
So let's talk a little bit about what the changes are versus what's in place today and kind of paint the picture of to have our current understanding. So, from like a business point of view, kind of what are you learning that is going to be different than what we are seeing in today's law?
Well, first thing that I want to point out is that obviously, as I mentioned, this is just the House bill. So this is where we are today. The Senate's going to revise it. They're going to reconcile. So this might not be where we end up, but this is what's coming out of the bill. And I'm going to just kind of try to touch on some of the major provisions of the bill, which many of those probably will stay pretty close to the version it is now. So the first thing is that the bonus depreciation that was brought into effect in the TCJA in 2017, and that's where they increased the bonus depreciation to 100%. So that's, for almost in general, for property that has a 15-year life or less, you could expense the whole thing in year one. So that has been dwindling down over the last few years. It started at 100 and has been diminishing by 20% over the last few years until like 2025 is only a 40% year. But the proposal in this bill is that for property acquired after January 19th, 2025, we'll be back at 100% bonus depreciation. And they're going to increase the Section 179 depreciation also to about 2.5 million for new manufacturing facilities. Another big one that impacts a lot of our clients is the business interest deduction. There's a code section 163J that has limited the interest deduction to 30% of your income. And that's where the real rub comes in. What is defined as income? Currently, it's adjusted taxable income. So that's, what you're going to see on your tax return. So that's a pretty low number. And then you can only deduct interest to the extent that it's 30% of that taxable income. Well, this law makes that deduction be subject to 30% of your EBITDA, which is earnings before income, tax, depreciation, and amortization. So you take that taxable income and you get add back your depreciation, your amortization, and your tax. So now you're talking about a much bigger number, and the deduction is limited to 30% of that. So that your interest deduction won't be limited nearly as much as it was before. And then the other big business provision is the Section 199A, some people call it the qualified business income deduction. And this is a deduction for pass-through entities. So we're really talking about partnerships and S corporations here. And this is the deduction that those pass-through entities were getting, or I should say the shareholders or the partners were getting the deduction on their individual tax return, generally equal to 20% of the taxable income of that entity. There are a lot of limitations and qualifiers in there, but for the most part, the deduction was 20%. And they're going to increase that deduction to 23%, effective for years beginning after December 31, 2025. So I'd say from a business perspective, those are the key issues that I saw in the bill.
So, dude, just hearing what you're saying, what are some of the industries? It sounds like, and tell me if I'm right or wrong, the first elements you talked about around the capex and the business interest deduction, really around organizations that do invest in capital, like capital expenditures and equipment and such. You said the 15-year. So, what industries come to mind that this will be relevant to?
Really manufacturing. There's clearly a push by the president. His agenda is to bring business back to the United States, to develop manufacturing plants, to bring production, distribution, manufacturing back to the United States. And so even in areas, I think, outside of the tax areas that you see in the bill, I think those are the industries that will be primarily affected, and to the good. I think these will be, good proposals that will increase their profitability.
Excellent. Excellent. Thank you. Let's stay on the commercial side and the business side and talk about the state and local tax, research and development and tax credits. Can you give us some highlights and some of the preview of things that are under consideration?
Absolutely. So in the research and development area, there was a really interesting change to the tax law in 2022. I think almost since the 50s. So I think the tax law in effect for like almost 70 years was that when you had research and development expenditures, that you could take a tax deduction for that on your tax return. And then in 2022, there was a change in the tax law that required U.S. businesses to begin capitalizing and amortizing those costs over 5 years. And if it was R&D that was done in a foreign country, you were required to capitalize and amortize that over 15 years. I know when we saw that law come out in 22, we were all kind of shocked. I think we even held off filing a lot of our clients' tax returns that were big into R&D because we thought, oh, surely they're going to change this law. I mean, this has been the law of the land for 70 years. This can't go through. And so we extended, we waited, and they never changed the law. And so for the tax years 22, 23, 24, taxpayers have had to capitalize these expenses. It has been a huge hit for many companies. So in the new law, they are eliminating the requirement to capitalize and amortize R&D expenditures for U.S.-based R&D activities. If you're doing it foreign, you are still required to capitalize and amortize. And this provision is supposed to be in place from 25 through 29. We'll see what happens after that. You can still elect to capitalize and amortize if you choose to, but you just won't be required to. And we won't see many taxpayers doing that. They won't. Most people want to take that expense as soon as they can.
You understood. So those would be more maybe software, life sciences, kind
Yeah.
of medical
Yeah.
device type industry folks.
Absolutely. Yeah. Anyone who's developing, anything in that technology arena, yeah, you would be amazed at the dollars that technology firms are spending on R&D. Yeah. I mean, sometimes I know they feel that their whole payroll is, spending time on R&D in many instances.
It does sound it's kind of focused on getting that R&D work done in the United States,
Getting
given
it
the
to states and making it tax favorable to do so, because I think we're one of the most innovative and countries in the world, entrepreneurial, and let's get that done here and give you a tax benefit for doing it and bring all those jobs and all that work back to the US.
so pivoting now to kind of the personal side, there's an individual kind of implication, there's kind of estate and trust. What are we seeing for kind of individuals as this bill progresses?
Okay, so one of the I think that's been in the news a lot. People have seen that the Tax Cuts and Jobs Act, which was Trump's tax law in 2017, most of those went into play in 2018. That was a big reduction in individual taxes when that bill was in service in 2018. But many of those provisions are set to expire in 25, 26. So we were going to see a big in taxes. One of the things that this bill does is it makes those TCJA individual tax rates and the large standard deduction permanent. And that's important because two things happened in that 2018 tax law. Not only did they reduce the tax rates, and I think there's a lot of focus on the top tax rate went from 39.6% to 37%, but the rates trickled down and were lower across all income bands. But not only did those rates go down, but the brackets increased. So for instance, in 2017, you might hit that top tax bracket of 39.6 when you were in the mid 400s of income. When they increase those brackets, the tax rate is now 37%, and you're not going to hit that 37% until you're in the mid 600s. So it clearly was a tax law change. And when I ran projections at the time of the tax law, a lot of people were interested. Hey, did this new tax law, what did it do to me? Did it, increase? Did it decrease my taxes? I mean, for probably 90% of my clients, regardless of their income level, everybody's taxes were lowered. So this TCJA keeping those rates really is impactful to lowering people's tax burden. And as you may recall, in that law, they also upped the standard deduction substantially. And I think it eliminated like 50 to 60% of the people that were itemizing their deductions. And so they want to make that high standard deduction permanent also. Other smaller impact things are they want to increase the child tax credit from $2,000 to $2,500 for the years from 25 through 28. Then it's going to drop back to $2,200 in 2029, and it'll be adjusted for inflation after that. They are proposing there'll be an additional deduction of $4,000 for seniors from 2025 to 2028. That's only for people with AGI under $150,000, though. I think the reason for this is one of the promises that had been made. I don't know if it was a promise, but it was a proposal on the campaign, was that they would eliminate the tax on Social Security. And that is not in this bill. So I think that this is kind of a nod to, hey, we couldn't quite go there. And I think from a budget perspective, it was just too much of a cut. So I think this is a little nod to that group, say, hey, we're giving you something. We couldn't eliminate your full tax on Social Security. Now there were two other promises made on the campaign trail that are huge, I think, and are in this bill, and that is they're eliminating the tax on tips from 2025 to 2028, and they're also proposing to eliminate the tax on all overtime during that same period. It will, however, be limited to people whose taxable income is $160,000 or less. But if we think about the people that are, that have tip income or overtime, which is usually an hourly type wage person, I think that the economics on that makes sense. I'd probably group that's in that $160,000 or less kind of demographic. And they also brought back a really interesting deduction, which I think the last time we saw this deduction was in the big tax law change in 1986. And this is a deduction for car loan interest. So for the years 2025 through 2028, they're going to allow a deduction of $10,000 for cars where the final assembly is in the U.S. and your AGI does need to be at $200,000 or less in order to take that deduction. And there's one other thing that it's interesting because it can be hugely impactful, but I haven't seen a lot of press about it. I think because it maybe only impacts a few people, but those few people that it will impact, it is a large impact. There was a concept in the TCJA that discussed excess business losses. So this is the instance, I like to use this scenario because this is where I usually see it. Someone who invests in a startup company, and we all know that when you have a startup company, you're likely to lose money. Maybe that first 2-3 years, you can lose a lot of money in those first 2 to 3 years. But the deduction, there's a limitation on the losses that you can take on your tax return related to business losses. And it's adjusted for inflation. So in 2025, it's $626,000. So let's say, I put $2 million, I spent $2 million with my startup technology company in 2025, and that's my money. I'm involved in the business. I really put it in. When it comes to my tax return, I can only deduct $626,000 of that because I'm limited to every year. Now, the good news with this was, so now, in that scenario, I've lost out on $1.4 million deduction, but I could carry that over to the next year and take the deduction in the next year. And the next year, it kind of converted to an NOL in that next year. And so I could use it in the next year to offset 80% of my income in that year. So even though you were taking a 1-year hit, the turnaround to utilize these losses, it's a pretty quick turnaround. You just have to be like, okay, I got to wait 1 more year. What they're proposing now is that doesn't convert to an NOL. You get a carryover, but you're still going to be subject to those annual limitations. So you can only knock that out at the rate of $600,000 a year. And so, if in that scenario that I suggested where, like, let's say I have my startup technology company, year after year, maybe I've lost, years 1 through 3, I've lost $6 million, but I got a great product. Then I sell my company and I sell it for $20 million. I got a great gain. And if I were into the other scenario where I could utilize, 80% of my income to offset that loss, they would kind of net each other, and I'd kind of be whole the year I sold, the year I sold. Well, now I'm going to have this big gain, and then I'm being ticking away at my $600,000 for 8 years, and maybe I won't even have the income to offset it in other years because, maybe my other income years aren't that great. So this can be a really big hit to a select group of people. The other thing is the estate tax. And, we all know that the TCJA increased limits were due to expire in 2026. And we thought that that exclusion from the estate gift tax might drop down back to somewhere between $7 and $9 million per person. They are proposing that we permanently increase that gift tax exclusion to $15 million a person for year 2026 and beyond, and be indexed for inflation in future years. So the estate tax is a pretty hefty tax. It's at 40%. So, and where that becomes really challenging is, if all your wealth is tied up in your business, and and then you're hit with a 40% tax, how do you pay that tax? You got to borrow money, you got to have insurance policy, you got to sell some of, your family has to sell some of the family business. So this can help many, this will help many people in that wealth range.
As we think about what's being proposed, will these kind of terms and these, as it comes together, be forward looking? So basically for this year, they'll start and go forward. Is there anything that would require or kind of be give opportunities to look back before kind of for prior years and kind of give over people and their organizations opportunities to look back to maybe kind of recover some, even reduce kind of tax act?
I haven't seen anything that impacts a year before 2025. So I mean, it could certainly change decisions. I mean, obviously, people have made decisions and done things in 2025, and this will go. Most of these provisions are going to go back to the beginning of the year. The one that really stuck out to me was the placed in service date for the bonus depreciation. I found it interesting that that's a January 19th, which is Trump's inauguration was January 20th, so I'm sure that's why that's the date. So I would certainly advise my clients, if you place, watch your placed in service date, because you'd hate to place your property in service January 10th and miss out on this 100% depreciation. But to your point, Sam, we have seen things in other bills that lightened up, for instance, the excess business loss limitations. They came out I think in the COVID years in 2022 and said, hey, we're going to lighten that up for 18, 19, and 20. And I had many clients that could go back and amend tax returns and take a ton of losses that they couldn't take before. And I haven't seen anything like that in this bill that would allow you to go back and do anything other than back to the beginning of the year, this year.
Before, as we wrap up, is there anything, I know this is not even at the Senate, it's just arriving there now, and then it hasn't hit the president's desk. Is there anything that a business owner or an individual should start to think about and start doing? Or just kind of keep your ear to the train tracks and kind of let this come together?
I would say that, again, that they might want to start doing some planning regarding that excess business loss. If someone is up for is having what they think is a big liquidity event in 2025, the problem with that is now there's no it's very hard to plan now that the law is going to change right here midstream. But there are things you can do to minimize the impact of where if you thought you were going to take a big loss to offset some cap gain, there are some things that you can do to minimize that hit of the cap gain if you're not going to get that big business loss right off now, in terms of leveraging some of your other investments to maybe generate some losses to offset that cap gain that you're going to have. So there are some pretty, I would say, individualized techniques, and it really depends on what investments or your other underlying assets you can bring to the table. But there are certainly things that you can do. And obviously the whole push of the bill is, and I'm only talking about the tax impacts here, but clearly, and I don't think this will be a surprise to anyone, it is really to bring business back to the U.S., to bring manufacturing back to the U.S., to, promote anything that will develop business in the U.S. So that's generally a theme. So, for companies that have overseas operations, just look at the things that they can do that will really provide some nice tax benefits if those things are done in the United States. There is one other thing I wanted to touch on that I think you asked about it, but I didn't quite get to it. And this is the one that was really in the news today, and it's a state and local tax limitation. In the TCJA, we had the state and local tax deductions that you can take on your tax return was limited to $10,000. And that was a real bone of contention for, the states with high income tax rates, which tend to be for the most part on the coasts. They have proposed to increase that state and local income tax deduction to $40,000 instead of $10,000. There are a lot of caveats with that, though. First of all, when your income is at $500,000 or higher, they're going to start reducing that $40,000. In the last that I saw, they're going to reduce it by 20% to the extent your income is over 500,000. So that would mean by the time you're at $600,000 of AGI, you've lost almost the whole benefit, and you're back down to the $10,000. But you can't go below $10,000, and they're never going to make that cap below it. That's the good news, I guess. The bad news is, I think it's a reconciliation budget. There have to be pros. There have to be things in the pros column and the cons column. They need a revenue generator sometime to offset, the revenue that they're going to lose. And many of the states have come up with these pass-through entity tax, which a lot of people will have heard of. And it's a workaround for this state and local tax deduction. So if you're a partner in a partnership or a shareholder in an S corporation, so pass-through entities, you have the option to basically pay your state taxes at the entity level. So then the entity gets to take that deduction, and then they pass out a credit to you to claim on your tax return. It's been a great workaround for those who are in pass-through entities. And it tries to put them on a more even par with a C Corp, because a C Corp does get to deduct all of their state and local income taxes. Well, their state and local that they pay on their federal tax return. So it's a great workaround. Almost every state has it. But they're going to limit it now to qualified trades or businesses, which is kind of the businesses you were talking about before. I think of the manufacturing, the distribution, operating companies that actually, make something, and they are going to eliminate professional service providers, such as attorneys, doctors, advisors, accounting firms like us, that we would no longer be allowed that deduction. So that is a huge hit to the services firms. And makes me wonder, I think we need a stronger lobbyist in DC for our industry. But that's how the bill reads now. Those are two really important things. And then one other quick thing, they're increasing the opportunity zones. They're opening those back up again. The opportunity zones where you could defer cap gains for up to 7 years. And if you held the investment for 5 or more years, you could eliminate 10% of your gain. Well, all of that was expiring because the 7 years have passed. It's all expiring in 25, 26. They're going to open a whole new round. Governors can pick new opportunities, and people can defer cap gains again for up to 7 years, up to 2033, eliminate 10% of their gain if they hold it. And if they invest in rural areas, they can defer 30% of the gain if they hold that for 5 years. So I think those are the key tax provisions in the bill. Of course, the bill is 391 pages long, so there's a lot in it. Clearly, I haven't touched on anything. And probably one of the things that I found the most interesting about the bill was when you pull up the committee report. It's really called One Big Beautiful Bill. That's the name of the bill. So we'll be referring to the One Big Beautiful Bill for I guess years to come now. So.
It sounds like our team at Armanino is really tracking this closely. A lot of moving parts, and look forward to seeing how this evolves. And look forward to having this conversation again as this migrates to the Senate, and then see what happens when the two parties the two teams need to get together to a final proposal for the president to sign. So thank you for taking time.
Thanks, Sam. Yep, we'll try to keep everyone updated, as we make it through, and maybe we'll have a new class for 4th of July.